Dave Ramsey is one of the most controversial figures in the entire financial world. Today, we're going to go and look at advice that Dave Ramsey gives and see what an actual financial advisor thinks.
In all the years I've been working with people who started from nothing and built wealth, we call them everyday millionaires. They typically say one of the things that turned their life around was they started asking, when they started looking at purchasing something, they started asking how much.
Okay,
so
good.
Rich people ask how much. Broke people, and I've been both, brother, okay? Broke people ask how much down and how much a month.
Yeah, he nailed it. I can think of I can think of many examples of people who are rich and who have no money. That is exactly how things work.
If you invest $100 a month from age 25 to age 65 in a decent growth stock mutual fund, it will be $1,176,000. You retire a millionaire. If you invest $100 a month from
investment return calculator.
Age 25 to age 65 in a decent growth.
Okay. Initial investment $0. 40 years of growth. Okay. Yeah. Okay. So he's technically correct. But you have to get about an 11.5% rate of return to get that. Don't expect that from most growth stock mutual funds. Most growth stock mutual funds are run by managers who dramatically underperform the index when the index goes down because they were in hype names, etc., etc. Might overperform when it goes up, but they give it all back when it goes down. And then the second thing is he's not including the cost of inflation. If we look at, let's not show that. If we look at the S&P 500 index, and then we divide that by inflation, which is a little bit understated, but it's good enough. Then you can see the returns like this shows in 1999 and 2000 how you were flat. Let's include. Can we include dividends? No, it's not gonna allow. It's not allowing us to include dividends. So this, I don't think this. No, this does not include dividends. But it shows how you essentially made a dividend between here and 2017. You had no return, inflation adjusted. So inflation adjusted, which we'll use 3%, you'll need to get like 14.5%. That's not happening. That's not happening. This is not true. You are not getting that return. Now, let's say we use an inflation adjusted return, 7%. and we'll use 200 a month. Oh, that was too low. We use 400 a month. It's $400 a month. $400 a month. That's just investment research. $400 a month, and you can retire a millionaire, inflation adjusted. Seems like a pretty good deal to me, but $100 a month isn't gonna cut it. Someone who looks at the last 10 years of returns and says, "Look at the S&P. It's up big." And I remember one example of someone who told me, like, yeah, over the last 15 years, all my funds are up, all the performance is like 15% or 12% or something. And then when you look at it, from 2000 to 2017, on an inflation-adjusted basis, this is an inflation-adjusted chart, they went nowhere. If we use a non-inflation adjusted chart, you can see how it dramatically outperforms. But on an inflation adjusted basis, which is the actual money in your pocket, you're not going to be spending. You're not going to be buying a house for the same price that you could 50 years ago. That's just not happening. Houses are a lot bigger today, and they're a lot better. But looking at the last 10 or 15 years of returns, that's just...
I'm looking at buying a house cash here in a couple of years, and I was just curious as I've started to talk to other people about it. They've all started to suggest not doing that, taking the money you'd spend on it, and throw it at other investments that'll make you more money. And I just kind of wanted to get your thoughts on why you would suggest buying a house cash, or if you wouldn't, what you would put it in.
I'm curious to get your thoughts on why you would take financial advice from a bunch of broke people.
That's a fair point.
That's
I'm looking at buying a house cash.
Yeah. Yeah. It's annoying. Okay. So if you look at the 30-year rate, this was filmed in 2024. So remove the comparison. Rates were between 7 and 6. Okay. I mean, it doesn't really make sense. That's the cat. To take a mortgage over, say, 6 or 7%, if you can pay it down with, for instance, take the bond portion of your portfolio. You're making maybe 5% there, and you're paying 6 or 7% on the mortgage. Now here, makes a lot of sense. Definitely take out a mortgage. Take out all the mortgages you can.
$3,200 in car payments? Oh my gosh! What are you driving?
It's a Rolls-Royce Ghost.
I guess. Oh my gosh! What is your income, dude?
Around $320,000 a month.
Phenomenal. A month?
Yeah.
A month.
Oh yeah.
Yeah.
Are you pulling my leg?
No, I started a digital marketing company, and that's my pre-tax monthly income.
So you're making $3 million a year, almost $4 million a year.
Pre-tax, yeah.
How old are you?
24.
Dude.
That's just insane. Congratulations. Listen, write a check and pay for the car and smile while you're driving it. $3,200?
Yeah. It can make sense to make financial decisions like this if you're making that much money. in this case, it's only like 1% of his income a year in car payments. For a lot of people, it'd be all or half of their income.
And I've watched them for my whole life.
3,200.
So that's that's the end of our video. There's a mix of very good advice.
I'm looking.
This is really good advice. And then
If you invest a
really sketchy advice that will end you up broke, frankly, when you look at the actual math, which is the thing a lot of people don't do. You need to look at the actual math that some random person online is using when they're talking about like this penny stock will moon, or Oracle, or Microsoft, or Amazon is dramatically undervalued. Not saying that they aren't. Not saying that they aren't. I own some of those. Not investment advice, but I have owned some of those. And yeah, take advice from a professional and learn what their incentives are. Dave Ramsey's incentive is more views. You get that. Think about it. I've been giving him views. Yeah. A financial advisor's incentive, let's say they get paid via commissions. Their incentive is to put you in more products and move you from product to product. Find someone who's a fiduciary, someone who charges fees as a percentage of assets under management. Thanks for listening, and see you sometime later. Bye.